Today, Netflix is reporting their earnings. Now, for you, an investor that's looking to get into this company, you've come to the right place. In today's video, folks, we are going to investigate the numbers of Netflix from a fundamental perspective, so you'll have an idea of where they stand financially and what you should be paying for this company today. Now, here's the thing with Netflix. Over the last 6 months, I'm going to pull up the chart here, they have been ripping their stock price. From July 2022, it's been at $220, give or take. Now it's up $100 to $324. So I'll load this up in the stock spec software here, where we're going to investigate those fundamentals. So we are ranking Netflix a 6 out of 10. It's a pretty mediocre score. And let's go through those 4 things that they are doing wrong. One is the price to earnings ratio, currently sitting at 107.51. That just indicates to us, folks, that on average Netflix has been trading at a premium. We like to find companies that have a pretty solid price to earnings ratio, ideally of 22.5 and below. Now, if you're in the company metrics category, it's indicating to us that the trailing 12 months price to earnings ratio is 28.04. So that's much more of an attractive price point, given the fact that their earnings have gone up and the stock price essentially has gone a lot lower. Take a look at November 2021, it was at a high of 657. If you bought here, one, obviously your investment has gone down a bunch, but two, you've been paying at a premium for this business, which you don't want to do. Their current ratio currently is 1.14, and it's not the worst. However, we want to find companies that have a current ratio of 1.5 and higher. That just indicates to us that they have a higher margin of safety in regards to paying off their liabilities with the assets they have on hand. Third, their debt to equity ratio is currently at 92.71. Guys, what you want is a company that has a debt to equity ratio of 50% and lower. That means that they're leveraging their capital through equity within the business and not taking on debt to fund their operations. So, in that regard, it's incredibly high and it's somewhat of a red flag. Now, fourth, their share dilution. Over the last 5 years, Netflix has been creating dilution with the amount of shares outstanding. We like to find companies that have been buying back shares. We want to find companies buying back shares, or at the very least, keeping the share count the same. Now, with those 4 things out of the way, there's a lot of positive things to say about this company. The return on equity is astronomically high, sitting at 24%, which is great. Their EPS, earnings per share, is up over the last 5 years, which is phenomenal to see. And their net income is up, their free cash flow is up, the return on invested capital average is sitting at 11%, which is phenomenal, and the revenue growth is also up. I like that the trifecta of the free cash flow, net income, and revenue growth is also all 3 of those things are high, which is great to see especially with a streaming service business like this. But the main thing with Netflix is the subscriber count. Now the earnings haven't been reported just yet, so we'll see once this video comes out. You'll know if you're watching the past post earnings, if the subscriber count has gone up or down. That'll be a huge factor going forward with this business, because will affect revenue growth in the future. Now, the most important thing is, what should we be paying for this company today? I'm going to load this up in the price analysis section of the software here. I'm going to do a 10-year analysis, so I'm going to price out this company 10 years in advance, and then discount it all back to today's values using historic numbers that this company has provided. So I'm going to fill out these boxes, so stand by. Before we jump into the calculation, folks, if you're enjoying the video so far, hit that like button and subscribe button. It means a lot to me, it means a lot to the channel. Now, here is what we should be paying for Netflix. But before we do that, I want you to take a look at this just quickly. And if you want to get your hands on the software, folks, follow the links in the description box below. 7-day free trial, have access to 10 years of financial data. Software pays for itself, and it's an amazing tool to speed up your investing research process. Now, here's the thing that I have a problem with Netflix: the free cash flow, which I didn't bring up. It's been quite a bumpy ride, along with pretty much only 1 year of positive free cash flow in 2020. Something I do not like, and this is going to really affect what we should be paying for this company, because here's the thing, folks. I have it all laid out in here, but I had to put my free cash flow margin, and it's quite difficult to figure out a margin considering I have negative numbers on the board. With a company that has, let's say, negative free cash flow, let's report on the board, I usually ignore companies like that because I like to see companies that have at least some sort of consistent free cash flow going forward. Now, I hit the calculate button, and it comes out to be an average calculation of 165.05. This company is grossly overvalued. And this is even considering positive free cash flow margins. Because look, as we expressed in the cash flow statement, they haven't expressed free cash flow only positive in 1 year, being 2020. So unless Netflix's price comes down to this 165 standpoint, I'm not even taking a look at this business at all. As well as the main concern here, folks, as I said, the free cash flow statement. Yes, the software said that its free cash flow has gone up over the last 5 years. However, where did it go up from? Negative numbers, and it's still in the negatives. We don't want that, guys. We want to find and we want to have consistent free cash flow, and ideally a price point of 165.05. If you enjoyed this video, folks, hit that like button and subscribe button. Final thoughts on Netflix. It is an overvalued company thus far. We'll see what happens with the earnings. However, from a price point perspective, I don't think it's worth jumping into this company just yet. That's the video, guys. Thank you so much for watching. I will see you in the next one.